On February 27, 2007, the stock markets fell substantially, by over 415 points on the Dow Jones Industrial Average, by 96.66 on the Nasdaq, and by 50.33, or 50.26 per the nightly business report, on the Standard & Poor's 500 average. I am struck by how technical analysis repeatedly failed to correctly time this largest decline since 2001. At the time of this writing, in the early evening of the same day, the Shanghai Index had opened upward by over 1.6%, the same market which presaged the worldwide decline earlier today. One type of technical analysis is to examine a security's price history as a chart, then to extrapolate the respective peaks or troughs toward intersecting future prices, and then to regard those intersections as signals to buy or sell the security respectively. A sell signal occurred in early September 2006, and again, in late November 2006, then another appeared in early January 2007, and again in late January 2007, and recently a fifth sell signal was generated. Some technical analysts might argue that this repeated set of sell signals is demonstrative of how effective technical analysis is. I would argue otherwise. The first sell signal, had it been utilized in September 2006 as a signal to sell, would have missed the substantial part of the subsequent gain which followed, another 10% or more. And to jump ahead to the fifth signal, one could easily argue that by this fifth signal that it had become the boy who cried wolf. Further, in my dissertation I found that if any value was to be found in trendline charting, it was to buy with the third signal using peaks and to sell with the first signal was using troughs, albeit for negligible excess returns compared to a buy and hold strategy and only to those paying the clearinghouse fee, available only to members of an exchange. Another way to show the weakness with technical analysis is to note that for technical analysis to be effective it must be able to differentiate which signals shall be deemed as valid. These 5 in a row sell signals seem to be ineffective. That is, had one acted earlier, one would have missed a major race on de-entry, to be, in the stock market, and had one acted later then one should doubt the efficacy of technical analysis in terms of its clarity to resolve which signal is significant. Yes, I should at this time note that the Dow Jones Industrial Average suffers from being a small sampling of 30 quality securities and that it is neither price nor market weighted. However, the Standard & Poor's 500 index had a similar chart pattern. I now leave it to the readers to supply, then test on their own trend lines and sell signals. I trust that a similar conclusion should result,